All right, let's talk about Chevron, ticker's CVX. In this crazy market, everyone's looking for something solid. So we're going to dig into why this energy giant could be a really smart play in early 2026, especially if you're hunting for some reliable income and steady growth.
So here's the big question, right? In a market that's all over the place, where do you actually find a safe, growing stream of income? It feels almost impossible sometimes. But what if a company that's been around forever, a real old-school energy player, actually has the answer? Let's see if Chevron can be that rock-solid foundation for a portfolio.
Okay, first things first, let's get into the dividend, because honestly, this is the anchor of the whole story for Chevron. We're talking about a long, long history of paying shareholders back. It's basically in their DNA.
Check this out. 39. That's the number. And what does it mean? It means for 39 straight years, Chevron has raised its dividend. Not just paid it, raised it. Think about everything that's happened in the last 4 decades. Recessions, oil prices crashing, you name it. And through it all, they kept bumping up that dividend. That is some serious dedication to shareholders.
And yeah, that 39-year streak puts them in a pretty exclusive club. They're what's called a dividend aristocrat. And it's not just a cool name, It means they're one of the top-tier companies in the S&P 500 that has a proven track record of increasing their dividend for at least 25 years in a row. For an investor, that's a huge sign of financial muscle and stability.
And that commitment really pays off for investors. Just look at this. In early 2026, Chevron's dividend yield is sitting at about 4%. Now, compare that to its biggest competitor, ExxonMobil, at around 3%. And then look at the S&P 500 as a whole, just 1.4%. We're talking about a yield that's almost 3 times the market average. If you're looking for income, that is a huge, huge difference.
So you might be asking, is that 4% yield safe? And the answer is a resounding yes. How do we know? Well, it's all backed by a mountain of free cash flow. We're talking over $20 billion a year, consistently. Free cash flow is basically the cash left over after they've paid all the bills to run the business. It's pure profit they can use for whatever they want, and they choose to use a big chunk of it to pay us, the shareholders. That dividend is safe.
Okay, so a killer dividend is awesome, but for that dividend to keep growing, the company has to grow too. So, what's fueling Chevron's future? Let's pop the hood and see what's powering this engine.
And here's the number that should get you excited about the future. For 2026, Chevron's own management is guiding for a 7 to 10% jump in production. That's not just some pie-in-the-sky number. That's their actual plan. It shows they're not just sitting back. They're stepping on the gas.
So where's all this growth coming from? Well, it's coming from some of the best oil and gas real estate on the planet. They're still ramping up in the Permian Basin. That's super low-cost oil. Then you've got the huge developments in Guyana, which the Hess deal really juices. And they're doing all this without breaking the bank, spending about $18 to $19 billion and being super picky about only funding the most profitable projects.
And this really boils down to a simple but incredibly powerful flywheel effect. It works like this. Step 1, you pump more of that low-cost oil. Step 2, that generates way more free cash flow. And step 3, that cash goes right back into shareholders' pockets through bigger dividends and buying back stock. It's a beautiful, self-reinforcing cycle.
All right, we've got a great dividend and a solid growth plan. But is this stock a good deal? Let's talk valuation. So, if we put Chevron side by side with Exxon, its biggest rival, something really interesting pops out. Their PE ratios, pretty similar. Both are in that 23 to 26 range. But look at the dividend yield again. Chevron's at 4%, while Exxon is at 3%. For the same price, you're getting a significantly bigger payout. For anyone investing for income, that's a pretty clear winner.
And hey, don't just take my word for it. Wall Street analysts are pretty much on the same page. The consensus is overwhelmingly positive, with most slapping a buy or strong buy rating on the stock. And why? They're pointing to the exact same things we've been talking about, that production growth and all that cash being returned to investors. Okay, so it sounds great, but we have to be real. No investment is a sure thing. So let's do a quick reality check and look at the risks before we give our final tick. All right, what are the big ones? Well, number 1 is always going to be the price of oil. It's volatile, and that's just the nature of the business. Then there's geopolitics. Stuff happening in other parts of the world can always throw a wrench in the works. And of course, the big, long-term question is the shift to cleaner energy.
But, and this is a big but, Chevron's super strong balance sheet and its focus on pumping the cheapest oil possible really help to buffer against these risks.
So let's wrap this up. What's the final verdict? It really comes down to three things. One, you get that rock-solid 4+% dividend that's been growing for 39 years. Two, you've got a clear path to 7 to 10% production growth this year. And three, the valuation looks really good, especially if you're an income investor. It's a powerful combination. Look, if you're a long-term investor and you want that sweet spot of income and growth from the energy sector, Chevron is making a really compelling case right now. This isn't some crazy high-risk growth stock. It's a compounding machine built to last. So the real question you have to ask yourself is this the kind of powerhouse you want as the bedrock of your energy portfolio?